Hi, and welcome to the Macro Show. We talk macro, and you wonder, did the Fed just signal the end of the bull market? Because the SLR rule, my friends, it's back. And is it bond bearish, or is it really a form of private sector QE? We're going to answer those questions, look at the economic data, go over the credit data, and who knows what else I've got in store for you. I'm your host, Steven Van Metre, and thanks for joining me today. And what is going to be a pretty exciting edition of the Macro Show, because I think I've got this SLR rule all figured out. And perhaps that also means the bull market's over, or soon to be. Pretty interesting. So what I think, and I want to show you, because I'm missing a few pieces here. I mean like one or two pieces as we go through this. But I'm pretty convinced, looking at the data, the SLR rule is a form of private sector QE. Now again, there's some missing details. I am certainly considering calling the team together. That's right. I'm thinking about calling Earl DeCrayon, Travis Kimmel, and Master Shake, Brent Johnson, Santiago Capital, and having a meeting of the minds to see if we can figure this out. But I'll let you be the judges. Let's take a look and see what's going on. And then there's some questions that came up. I want to kind of answer those as we go through. I did put together a written update on this. It's on the website. I'll link to it in the description. If you follow me on LinkedIn, Facebook, or Twitter, you probably are seeing it somewhere already. All right, let's go to the Federal Reserve webpage again. And I've got this highlighted. It said the change would exclude U.S. Treasury securities and deposits at Federal Reserve banks from the calculation. Now, if you think about what it means by the calculation, it just means, look, when doing this SLR formula, you have to add those in. Now, just based on that alone, it doesn't imply selling unless you interpret that to mean the way to get your ratio down is to sell Treasury securities, which would be an accurate assumption of how math works, unless there's a reason that's not so bad. Let's take a look at the data. So here we've got Treasury and agent securities, non-mortgage backed at all commercial banks. And from the start of the SLR in September of 2014, all the way to the end, wow, that thing that apparently is so bond bearish caused them to add over $300 billion of Treasury securities. Now that's really weird. It doesn't that seems like interesting. You say, well, maybe it's because before that they were doing something. Well, let's back up. Whoops, that's not a good way to back up. Let's try that again. Let's back up and say, well, between 2010 and the implementation of this SLR rule in 2014, they were net neutral. I mean, they just kind of trended along around, somewhere between 550 billion. And then all of a sudden, boom, SLR rule goes into effect and they're buying a whole bunch of these things. Now let's see what happened after the SLR went into effect. Well, they bought more. Now, I want you to think about this. If the SLR is so bad that it leads to massive selling of Treasury securities, well, then why did they buy some? Now, I know what you're saying. Oh, that's because the banks are saying that the SLR exemption is really good, and that means they buy Treasury securities. You mean just like they did during the rule, where they added $300 billion? So you see there's a disconnect here, and we're going to figure that out. I'm going to show you what I think that disconnect is, because there's a lot to how this whole bull market got created by just the SLR exemption alone. Now let's look at Treasuries, because again, we've heard, oh, this is going to cause yields to go way up, right? Well, here we are. SLR rule starts. Wow, SLR rule ends. That's odd. Most of the time, yields didn't go anywhere. In fact, they stayed flat, and they did go down. Now, at some point, let's look back in history here, because there's really some interesting history that goes on. QE3, guess when QE3 ends? Yeah, right at the start of the SLR rule, within 1 month of each other. So in September of 2014, the SLR rule starts. QE ends October of 14. If I got that number right. Now, isn't that interesting? And yet yields went nowhere, despite the fact that the SLR was super bullish on yields, is what everyone's claiming. Now, and here's some more proof that perhaps this is private sector QE, just being forced by the banks to do it. Or maybe the bank's willing to do it. I don't know. Obviously, there's a regulation involved. Now, when did the Fed start quantitative tightening? They started it in October, right here, 2017. And how long did they run it for? All the way to October 2019. Now, what does quantitative tightening do? Now, I know you know the answer to this question. Is it bullish or bearish for yields? You know, which is it, bullish or bearish? Yeah, it's bullish. So the whole point of quantitative tightening is to raise rates. So what should we see here? We should see rates rise between October 2017 and October 2019, and they didn't. Which goes to show perhaps just how powerful this SLR rule is. To add to that view, do you remember what happened in October 19 other than the fact that the Fed stopped doing quantitative tightening? Yeah, they restarted QE. Remember, all of a sudden, whoa, man, we made a mistake. We went too far. We got to start easing. And look what happened. SLR plus QE, yields collapsed. Now you go, oh, well, this was due to the pandemic. This moved down in February. It was before the pandemic. It was before. So SLR and QE, wow, seems like a pretty powerful duo there. Now, where did some of this come from? Why? There's this great article on Zero Hedge facing up to JP Morgan's leverage relief threats. So what actually did this SLR rule do? Well, it did something interesting. It allowed the banks to start massively lending, right? We talked about that to fill the credit lines of corporations, but they also were filling credit lines of who? Investors. Yeah, a lot of margin debt. And why? So why do you think when you hear from these bank analysts and all these, bank insiders, oh, the SLR's got to, the exemption needs to stay, right? You're getting rid of the exemption. Worst thing ever. We're going to sell all these treasury securities that even though we actually never did before, we actually bought them. Why would they want this back or to stay on force so bad? Yeah, because during the pandemic, when every other company was getting smashed, you look here, the 6 largest banks reported trading and investment revenues that were $27 billion higher than their pre-pandemic averages. Hey, they had massive tens of billions of dollars in revenue because there was an SLR exemption. And when in doubt, you got to follow the money of what's going on. So it's kind of interesting because, you see this, right? So here's a piece from Wall Street. He says, the way too fast change in margin debt from a year ago. He said, look, whoa, year over year basis, way too fast. That's off the charts. And then he shows here the way too fast spike in margin debt. You look at going into the dot-com bust, there was a lot of margin debt. Going into the financial crisis, there was a lot of margin debt. Going into the December 18 crash, there was a lot of margin debt. And look, he says, way too fast. Look at that, boom. Where did that march? Yeah, and what happened between then? The SLR exemption. That's what happened. Now, isn't that interesting that, you start wondering, why would the banks want to keep this exemption around a little while? Because they made a lot of money doing it. And they could set these price targets on the S&P and whatever real high. Because the way it works is, let's say you have like $10,000 and you get a margin account. And I don't know what the margin rules are, but we'll make it 50%. So now I have 15,000. So I put all of that in some, high-flying tech stock, and it goes up. And guess what? My margin amount increases. So let's say, it goes to 30,000. I double my money, right? And then the bank on the way is going to say, wow, Steve, you're doing real well. Now that you have this kind of money, we're going to extend your credit line. And so you just get this thing feeding on top of each other. Now you think of this from a treasury security standpoint. If you've got stock just rising because there's just so much credit being put out there, then why would somebody want to short treasury yields? Because they're going to borrow those treasury securities, right? Sell them and take that cash and buy more securities and have more margin. And now you're starting to see why, despite being we're actually in a pretty bad recession and still dealing with a pandemic. There's over 18 million people unemployed. Why are stocks going up? Was it really because there was all this inflation expectation? Or was it because when you take fiscal and you take monetary, you really don't get anything, which we already know. But when you take the SLR exemption and stack the three together and you get a credit expansion and people start buying risk assets, what does it look like? Yeah, it looks like inflation, right? Now, what's interesting is a lot of people said the Fed was going to bow down to the banks and give them the exemption because they were going to buy into the fact that, this is, if you take this away, Fed, we're going to sell treasury securities, even though we actually bought a lot of them before, as we've seen. And I said that's not going to happen. Now, we could go through all the circumstantial reasons why, but there's one thing we need to really go back and look at, and that's this letter from Senator Elizabeth Warren and Senator Sherrod Brown, both of the Senate Banking Committee. And why would they send out and make this letter public, where they're telling the Fed, Jay Powell, hey, you and your team over there at the FOMC, you need to put this rule back on. Now, even though it was not entirely up to the Fed, the FDIC gets to weigh in. But I want you to understand something really important. Who makes the laws in this country? Is it the Fed or Congress? If you pick Congress, you got it. Congress makes the rules. Now, what is the Fed? They're a banking regulator, right? I mean, that's their job. They regulate the banks. So effectively, they enforce the rules that Congress tells them. And so what did the Fed do? Let's go, the Fed gave the banks an exemption. And everybody was cool with it because they said it's temporary and it's going to expire. But do you remember back in December during the Trump, I'm now getting used to saying the term relief, but it was that pandemic stimulus. Yeah, there it is, stimulus I'm looking for. Do you remember that? And what did the Senate do as part of the terms of that deal? They said, hey, look, Fed, you've got all these emergency programs out and you're not using any, you're barely using them. And the Fed's like, oh, no, but we need them. We don't want to get rid of them just yet. And the Senate said, no, look, give us back some of this money and we're cutting these programs out. Because the whole idea is they don't want the Fed to overextend its limits. And so the reason I said the exemption was going to end is because the Fed does not write the laws of this country. Congress does. So why would, Elizabeth Warren and Sherrod Brown come out with this letter to remind the world who is the lawmakers in our country? It is them. Because now, why don't you think of this position, right? Politically, from the government perspective, is you have a banking regulator that was going to go out and potentially tell the world that whatever the Senate writes as a law, he will determine if that law is okay and that if it needs modification. That's not how it works. He's a banking regulator. And that's how you knew that he was, even though he entertained the banks, that in the end of the day, he is not the lawmaker. So that's how we get to the story. I'll let you decide, but to me, it looks like a form of QE by the banks. And effectively, it's designed to be this, which tells us a number of things. If this margin debt's going to unwind, right, which is going to have to, because of the rule coming back into place, what does it mean for stocks? It's bearish. What does it mean for crude oil? Bearish. What does it mean for, say, precious metals? Bearish. Commodities? Bearish. What does it mean for the dollar? Go back to when did the dollar peak and start going down? It peaked around March, April, and it's went down. Dollar bullish? How about bonds? Same thing. It is bond bullish as well. So banks are going to be buying bond. Now we know the rule goes, the exemption ends at the end of the month. Does that mean they'll be positioning before this? Most likely. But now you kind of know. I think this is a form of QE. And when you mix SLR plus QE, well, now you've got interest rates that are likely going way down. And what does falling interest rates mean in terms of financial conditions? Does it tighten them or does it loosen them? Yeah, it tightens them until you get lending growth. That's the key. So it tightens financial conditions. And what did we see, right? Interest rates. Oh, this thing that apparently causes interest rates to go up only looks like 5s and 7s went up today. Everything else went down. And I think briefly we saw the 3, 6, and 1 year briefly dip negative if what I saw on Twitter today was right. Let's take a look at the economic data. Going back here a little bit, we got CPI from did we go over that already? I think we did. Okay, let's move into Thursday. What interesting things do we have? Unemployment data. Let's take a look at that. Initial claims up 770,000. What we're starting to see in the claims data is people that originally lost their jobs, then went back to work at some point, are now losing their job again. Yes, it does count as an initial claim because they were back to work for a while. And look at the total claims sitting at 18.2 million. The only good thing, it was down 2. I don't know if this is people falling off or people going back to work, but this plus 770,000 is telling you there's structural issues in the economy. And I think the stock market, now that this SLR exemption is going away, is going to more accurately reflect that. Let's also take a look. The only other thing in here was the Philly Fed manufacturing survey, and this is really hot. You can go to the Philly Fed website and pull this up. But the diffusion index, just to remind you, represents the percentage indicating an increase minus the percentage indicating a decrease. And so here you can see general business activity plus 50%. Firms, 50%, 52% of them saying an increase. How about new orders? 51% of firms. Shipments, 30% of firms. Unfilled orders up 21%. Delivery times, no surprise, 29.5%. Inventories, 12% of firms reporting increase. Prices paid, 76%. So you start to see what happens in these reports as you start to see the peak of inflation, not where forward looking, but the peak. This is a very, very high number. How about prices received? Yeah, 32%. So 32% of firms said they could get higher prices, where 76% of them said they paid more. And that's how margins get squeezed and profits get squeezed. Number of employees up 30%. Average firms reporting more employees, not number of employees, up 30%. Average work week, this is good for the employment statistics, up almost 40% of firms reporting longer work week. All right, let's take a look at the banking data. What do we have here? Bank credit up $49 billion. That's good. Securities and bank credit up $8 billion, with mortgage-backed securities up 4. Treasury securities down 6. What's interesting, the Treasury securities were right back where they were in December. So this thing that the banks claim and gives them the latitude to buy a bunch of Treasury securities, yeah, certainly doesn't work that way at all. So obviously we know they'll be back buying more once that goes back in force. How about loans and leases up $40 billion? Commercial industrial, where is that? Up $26 billion. Real estate, a mere 2. And real estate's really, really important. You need, this is why these higher interest rates are not working in real estate. You need credit expansion, and that you get with lower rates. So higher rates in a period of a liquidity trap are tightening financial conditions until they're low enough to spur credit growth. Consumer loans up $2 billion. And how about cash assets at the bank? That's up a whopping $84 billion as cash continues to pile up at the banks. All right, let's take a look at the PowerPoints. What do we have here? We've got real estate loan growth now negative on a year-over-year basis. So that's telling you interest rates are too high, as I've been saying. And 6-month rate of change is negative and falling. 3-month rate of change is negative and falling. How about commercial industrial loans? I know there were some big loans that were getting funded, and so maybe they're showing up here. The year-over-year is down to 10%, and the 6-month rate of change is negative 4.74. 3-month rate of change reflecting some of these loans probably getting closed as before, locked in and closed after rates rise. They were locked in before rates shot up and getting closed now. Loans and leases and at all commercial banks, growth rate is down to 2.44% a year. So what you're seeing is not a lot of money growth, and that's what you need in a liquidity trap. 6-month rate is negative and rising. 3-month rate and change, thanks to commercial industrial, is slightly positive. And how about consumer loans? Now, don't get excited about this. It says up 12.7%. Yeah, from minus 13% from a year ago. So minor blip there. No real demand from the consumers in terms of credit growth. So with that, we'll probably look at the charts on the Sunday chart show. But as of now, question is the bull market over? Because all of this credit is going to get pulled by the banks as the SLR exemption goes away. Well, looks like it's me. I'm your host, Steven Van Metre. Thanks for joining me today. Thanks for tuning in. And we'll see you on Sunday for the chart show and Monday for the macro show. Have a great weekend. Bye now. The content of this video is provides educational information only and not intended to provide investment advice. This shows not to be construed as a recommendation or solicitation by or selling security, financial instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre. Personal capacity opinions expressed in the video that do not reflect the of Atlas Financial Advising or Steven Van Metre Financial.